Hey everyone, and welcome to today's explainer. So I want you to imagine, just for a second, that you're playing this massive, high-stakes game of tug-of-war. You're pulling with all your might, but you're effectively blindfolded. Now what if you could put on a pair of special glasses that suddenly let you see exactly where the biggest players are standing, how hard they're pulling, and exactly where that rope is going to end up? I mean, you'd win a whole lot more games, right? Absolutely. Well, today, as your mentor, I'm going to give you those exact glasses for the gold market. We are going to completely decode the options open interest heat map.
Okay, so here's our quick roadmap for today. We're hitting the concert ticket analogy, market gravity zones, ceilings and floors, how to actually trade the heat map walls, combining all this with COT data, and finally, your 8-minute morning routine. We designed this specifically for retail swing traders to help you take what looks like incredibly complex options data and turn it into a really simple, actionable strategy you can use every single day.
All right, part one, the concert ticket analogy. Let's start with the absolute basics, because before we can read the map, we really need to know what we're mapping. To really wrap your head around options, just think of a highly anticipated concert. Let's say you pay a buddy $20 today for the right to buy his $100 ticket anytime before the show. If that show sells out and tickets skyrocket to $200, well, you use your right, you buy it for $100, and you make a massive profit. But if the band suddenly becomes totally unpopular and tickets drop to $50, you just walk away. You only lose that initial $20. And that, right there, is the core difference between a call and a put. You buy a call if you think gold is going up, and you buy a put if you think it's going down. You're paying a small premium for the right, but crucially, never the obligation to make a move. Moving right along to Section 2, Unlocking Market Gravity Zones. Now that we've got a handle on what options actually are, let's look at how we track all these market promises to find these hidden gravity zones where the price of gold is either magnetically pulled or violently rejected.
The absolute secret to finding these zones is a metric called open interest. Think of open interest as basically a giant promise counter. It ticks up every single time someone makes a promise in the market, and it stays active until that promise is fulfilled or it expires. These aren't just random numbers floating around. They actually act as massive magnets for the price of gold.
You know, beginners mess this up all the time. So let's clear it up right now with a simple highway analogy. Volume? That's just the number of cars passing by on the highway today. It entirely resets to 0 at midnight. But open interest? That represents the cars permanently parked on the highway. We really don't care about the passing traffic, we care about the parked cars, because those are the massive physical obstacles the market has to somehow navigate around.
And this brings us straight to the heat map itself. The heat map takes all those parked cars, all that open interest, and color codes the whole thing for us. Bright red and deep orange, that means extreme heat, massive piles of open interest. Blue or black means it's totally cold, nobody really cares, and price can move freely through it. When you look at this, your eyes need to naturally gravitate to the brightest red zones.
Which leads us perfectly into Section 3, ceilings, floors, and the big players. Because to understand why these hot red zones act as actual, physical barriers in the market, we really need to talk about who exactly is on the other side of these trades.
Here is the crucial dynamic you have to understand. The really big players, they sell options, and they profit when those options expire completely worthless. For every retail trader out there buying an option, there's a massive institution or bank selling it to them. And these institutions want to keep the premium you paid them. So if the price of gold gets uncomfortably close to a level where they would lose billions of dollars, they step in. They buy or sell the underlying gold futures with overwhelming force just to push the price away. They are literally building walls. So when we look at the brightest red cluster of call options sitting right above the current price, we find the call wall. You've got to think of this as a literal concrete ceiling. When gold rallies and hits this specific strike price, the big institutional sellers panic. They start shorting gold incredibly aggressively to keep the price from breaking through. Honestly, this is exactly where rallies go to die.
And on the flip side, if you look below the current price for the brightest red cluster of put options, that is your put wall, it's your floor. If gold is crashing, this is exactly where the massive banks will aggressively buy up gold to defend their positions. They are physically preventing the price from dropping any lower. They will literally step in and catch the falling knife.
Now let's look at how all this builds across time to locate the absolute strongest wall clusters.
Because options have expiration dates, timing is everything. These walls are absolute fortresses in the 0 to 5 days right before they expire, mostly because the big players are in a frantic final defense of their positions. But if an expiration is, say, 15 or 30 days out, those walls are just weak guidelines. For your daily trades, you want to focus heavily on the nearest monthly expiration.
Okay, Section 4, Trading the heat map walls. Let's put our trader hats on for a second. We've successfully identified the ceiling and the floor. But how do we actually make money from this information?
Here is your exact step-by-step playbook for the call wall. If gold rallies and gets within 10 to 15 bucks of that bright red ceiling, you want to sell or short. The probability of price getting rejected there is incredibly high. You just place your stop loss right above the wall. But, and this is absolutely crucial, if that wall actually breaks on double the normal volume, it means the institutions have totally failed. They're trapped. In that scenario, you have to adjust your exit strategy immediately, flip your bias, and buy the breakout, because the price is about to explode upward.
The exact same logic applies down at the put wall. When gold drops near this floor, you buy the bounce. You go long with a really tight stop loss right below the wall. But again, if that floor suddenly collapses on massive institutional volume, the defenders have lost the battle. You must exit your long position and sell the breakdown, basically riding the wave of their forced liquidations.
There's actually one more hidden force you need to track here: max pain. This is the specific price level where the maximum number of option buyers lose everything, and the institutional sellers make an absolute fortune. In the final 2 or 3 days before an expiration Friday, the market acts like a giant vacuum, just pulling the price of gold straight toward this specific number. Always note where max pain is relative to the current price.
All right, Section 5, Combining the heat map with COT. Reading the heat map by itself is awesome, but to trade like professionals, we need to layer our edges. So, let's combine our heat map data with the commitments of traders, or COT framework.
When you put these together, it basically creates the ultimate cheat code. The heat map tells you exactly where the physical obstacle is, and the COT data tells you what direction the big money is leaning overall. When those two things align, it's just magic. Think about it. If your COT data is screaming bearish and the price of gold is right up against a massive red call wall, that is a strong sell. It's the perfect storm for a high-probability trade. You've got the macroeconomic wind at your back and a concrete ceiling right above your head.
Let's move to Section 6 and tie all this together. I want to give you a highly actionable 8-minute morning routine that you can, and honestly should, start using tomorrow before you place a single trade.
Step 1 of your routine takes just a couple of minutes. Open up your options platform, look at the nearest monthly expiration, and find the current price. Then, simply look up to find the brightest red cluster. Boom, that's your call wall, your ceiling. Then look down to find the brightest red cluster below you. That's your put wall, your floor. Just like that, you've established the daily playing field.
Step 2 is predicting exactly where price is going to stall out. I want you to literally, physically write it down. Gold will bounce at X and reject at Y. Then, at the very end of your trading day, check your work. Did the walls hold? Let me tell you, tracking this every single day is how you go from a total beginner to a master. You're going to build this incredible intuition for when walls hold like concrete and when sudden macroeconomic news is going to shatter them.
By looking at this heat map, you're doing what 90% of retail traders never even bother to do. You've got the special glasses now to see the hidden gravity of the market. You know exactly where the big players are anchored and where the ropes are stretched the tightest. So the only question left for you is, when you open the heat map tomorrow morning, will you play the bounce off the walls or will you catch the violent breakout? The choice is entirely yours. Keep learning, keep analyzing, and I will see you in the next explainer.